Series 7 registered in 1966 with Shearson Hamill. Bull market began, lasted 2 years. It was a great time to be a stockbroker. Then I went to Tucker Anthony, where I ran the options department for 5 years, and finally landed in a wonderful place called Drexel Burnham, which for 5 years was on top of the world. And there I worked with their quantitative database. And a lot of what I learned from George Douglas, who's still running Quant Money today, about earnings surprise and earnings estimate revision is central to the Chaikin Power Gauge rating. And they're the most sensitive factors, as you'll see in our model. And then I started an institutional brokerage firm, which we were fortunate enough to sell to Instinet, the electronic trading arm of Reuters, in 1992. I stayed there for 6 years and started Instinet Research, a 6-person quantitative research department within Instinet. One of the people who I thought I was training was Russ Kosterick, who's now the chief strategist for iShares. Turned out he was training me because he's a pretty smart guy. We've been fortunate enough to be quoted on CNBC, Fox Business, and just a month and a half ago, Barron's wrote us up as one of the top 2 quantitative sites on Wall Street. What's interesting is that the 3 firms I just showed you were all preeminent when I joined them. Not one of them exists today, but I'm still here, and part of the reason is I've got what's known as a reality-based approach to investing. And that means a combination of fundamentals and technicals, although the power gauge rating is 85% fundamental, as you'll see. So in the next 45 minutes, we'll talk about ETFs and why you trade them and use them to allocate assets, how to use the Chaikin Power Bar to rank ETFs, which is really important since there are so many of them. We're going to look at Chaikin relative strength and money flow as it pertains both to ETFs and individual stocks, show you how to identify shifts in industry group and sector strength, and then how to quickly find the strongest stocks in the strongest ETFs, which is a nuanced approach that a lot of the advisors I talked to in Los Angeles really responded to. So we all know that ETFs are popular, particularly index-type ETFs started with the spiders back in the 90s and then moved on to the triple Qs, and now there's a whole proliferation of index ETFs, and we hope to be part of that proliferation very shortly. More than $2 trillion in index-related ETFs, now surpassing the amount in mutual funds. Why? Because they give you diversity, transparency, liquidity, and lower fees, and they're obviously very popular among advisors who want to allocate client assets in a low-cost way. I don't know if any of you have seen the new commercial that Invesco is running on CNBC. If you have, type a big I in the question box, please. I just saw it this morning, and Chaikin Analytics was started 6 years ago with the idea that both high net worth individuals and advisors did not have to accept average returns. Love John Bogle, obviously started a revolution, but he does get carried away with it. Invesco has a commercial running that says, bench the benchmarks. They're creating a whole new series of ETFs that they say will help you outperform the benchmarks. That's what Chaikin Analytics has been about for the last 6 years. It's why we now have over 3,000 subscribers. So let's show you what Chaikin Analytics can do for you and your practice. Now, one of the big problems that everybody who came to our booth, and we sponsored the advisor forum along with BlackRock, so hopefully that's propitious in terms of the growth of Chaikin Analytics. Everybody has the same problem, information overload. We live in the age of distraction. And as advisors with multiple accounts and multiple assets to monitor, information overload is your biggest problem. Our option is Chaikin Analytics for both iPad and desktop. The iPad version enables you to bring the analytics with you to a client meeting or when you're on vacation or working at home on a Friday, so you want to see your grandkids or go skiing. And it can really help you grow your practice. It does that by improving your productivity, enabling richer client engagements. Chaikin Analytics basically combines fundamentals and technicals into a quantitative model called the Chaikin Power Gauge rating, And then we also give you buy and sell alerts, which are actionable ideas that you can use as a impetus for client outreach if the client warrants it, or to make your buy and sell decisions that much more timely. I'd like to start out by focusing on the stock market. Almost everybody who came up to our booth and in all the interactions we have with our advisor clients who are already subscribers, people are interested in the market. Where is it headed? I get quoted on CNBC.com once or twice a week. Most of what people say on there is pure drivel. If you check what I said yesterday, I talked about a big merger that was announced before the opening by Pfizer and said that that was a good thing on a Monday morning, but that basically this was all noise because we're in a trading range. Most people will not give you the straight talk. But we do have 3 proprietary indicators within Chaikin Analytics to really give you a leg up on your competitors in terms of knowing what the market is all about and where it might be headed. The first thing is Chaikin Money Flow, which has been around for 35 years. It's on every platform, every internet site, Bloomberg, Reuters, stockcharts.com. You name it, it's there, and it's done a great job, especially when you look at it in relation to the price action of the SPY, which we're going to do in a minute. Then we have something called the Chaikin Power Bar. For any list, index, ETF, group, client portfolio, we tell you the number of stocks with bullish, neutral, and bearish power gauge ratings. The power gauge rating measures the potential of a stock to outperform or underperform the market over the next 6 months. And we've now learned that it does a fine job looking 12 to 15 months out. And then finally, a new indicator, which I actually read about in Barron's 4 months ago that served us very, very well, is to check the relative strength of the RSP. Now, how many of you are familiar with the Guggenheim equal-weighted S&P? If you are, type a big G into the question box, please. And I see that we've got a lot of people who understand that the S&P, the SPDR, is a cap-weighted index. And in 2015, guess what happened? 4 stocks in the index, affectionately known as the FANG stocks, accounted for 70% of the price performance of the S&P. What happened to those other 495 stocks? Well, they're reflected in the relative strength of the equal-weighted S&P to the S&P itself. So let's start with a chart of the S&P, and those red lines show you why I think we're in a range-bound market. We made a W-shaped bottom in August, September. What does that mean? It means you had sort of a mini flash crash, rallied up, that's the middle of the W, and then came back down and tested the lows. In the cash index, we equaled the lows of 1867 because of those ugly market order dislocations on August 24th. The SPDR and the futures didn't make it down to their lows, so it looks like what's known as a bullish divergence. The key thing on this chart is that in the middle of the W, Chaikin Money Flow, which is right underneath in that red box, stayed red or negative. It should have gone green. On the other hand, when you came back down and made that lower low, look at the money flow. It was green, and then the market powered up to the 2100 level where it ran into resistance. Looking down at the relative strength, the average stock in the S&P was still underperforming the big cap names, the FANG stocks and the Apples of the world. How do we know that? Because our relative strength indicator is really simple. It fluctuates from red to green, looks back over 6 months, well constructed, doesn't whipsaw around typically, and on the eye, you don't have to deal with a whole set of numbers from 1 to 100. Now let's look at the bottom that we made in January and February. Another W bottom, but this time there was a lot more support for that SPDR low. And how do we know that? Because in the middle of the W, in late January, Chaikin Money Flow went positive, and it stayed positive when we made that double bottom. February 11th, Jamie Dimon doesn't want to take credit for turning the market. I'm going to give him credit. When he announced he was buying $25 million worth of JP Morgan stock, his own stock, the market turned on a dime. Real validation from someone who put his money on the line. And ever since February 11th, Chaikin Money Flow has stayed green or positive. even as we got oversold back in March, and then again Chaikin Money Flow, instead of going red or negative as it usually does, has stayed green. What does that tell you? It says the institutions are buying the dips. And we see that every day in the market. That's why we're locked in this trading range, because there are sellers who think the market's overvalued. They're afraid of interest rate hikes. They think the economy is going into a recession, but there are a lot of buyers out there. Why? Because U.S. equities are pretty much the only game in town. Do you want to buy bonds up here at all-time low yields and record price highs and run the risk of interest rates rising? You want to invest in China or Europe, where accounting standards and transparency are not what they should be? The economies are lagging behind the U.S. So there's a tug of war going on. Until we break out above 2100 or break below 2000, we're locked in a trading range, and that's probably going to characterize the balance of May as well. In June, based on our indicators, at the top is the power bar. There are 124 stocks in the S&P 500 with bullish Chaikin power gauge ratings, only 69 with bearish ratings. So even after a 3.5-week sell-off from the April top, our power bar is positive. Chaikin Money Flow is positive, and now the clincher. Look at the relative strength of the equal weighted S&P to the spider, or the S&P 500 index. It's now green. What is that telling us? It's telling us that the average stock in the S&P, which is still a large cap stock, is outperforming the large cap names. This is a sign of a very healthy market. You don't have to be a dyed-in-the-wool technician. Look at statistics. So that's the S&P. If you're looking for broad market exposure, a lot of people use the spiders. But some people also use the triple Qs. When do you use them? You use them when they're outperforming the S&P, as they did all through 2015 into early 16, because they reflect the sexiest portion of the market, the biotech and tech stocks. But something happened on the way to the party. In early February, the triple Qs started underperforming the SPYs. Now, how should that affect your decision making? Well, it's telling you two things. Tech and biotech are under pressure. And if you're looking for market exposure, you couldn't have gotten it in the small caps because the IWM was weak as well. Look to the S&P and stay away from the FANG stocks, because they're more reflective of the triple Qs. So in summing up, our market view, which is reflected in our weekly market insights that comes bundled with Chaikin Analytics every Sunday, is that we're in a trading range and likely to resolve it to the upside, and that a bear market is not in the cards right now. So let's take a look at a very disciplined bottom-up stock picking methodology. For those of you who still construct client portfolios, and our studies show that at least 50% of advisors still use individual stocks or have clients who are interested in them, we've developed a very disciplined methodology. At the top of the pyramid, but at the bottom of the whole process, is the Chaikin Power Gauge rating and our ETF rankings. At the bottom of the pyramid, just two technical indicators that work very, very well with this 20-factor quantitative model, and the sweet spot in the middle are Chaikin buy and sell signals. And we'll show you examples of all of that in just a few minutes. So what is the Chaikin Power Gauge rating? Well, at its heart, it's a very simple display. Goes from very bearish to very bullish, has predictive power 3 to 6 to 12 months out, which means that you can use it to guide your intermediate to longer term investments. But don't confuse simple with simplicity, because under the hood, you've got a Ferrari engine that's very powerful. And the reason I feel confident saying that is, A, the power gauge rating has been commercially available since January of 2011. So we have more than 5 years of experience helping advisors and their clients identify stocks that are likely to outperform the market and stocks that are potential landmines. 20 factors based on everything I learned in 45 years on Wall Street. The model was frozen in September 2010. For those of you who've looked at models before, you know that's very unusual. The weights are the same. Not each factor has an equal weight. So for instance, the financial metrics, which are Warren Buffett would look at, the value metrics are 35% of the model. They're the bedrock of the model. The expert opinions, which you don't normally find in a quantitative model, like short interest and insider activity and industry group strength, we think are the secret sauce. And the most sensitive factors are earnings surprise and earnings estimate revisions. Now, what I learned from George Douglas at Drexel, who built a great quantitative database, is that earnings surprises drive analyst estimate revisions, and they come in bunches. So when we look at some charts, you'll see that stocks that report a positive earnings surprise tend to do that quarter after quarter after quarter. Southwest Air in 13 and 14 was a good example of that. United Health, that we're going to look at in a minute. And unfortunately, when they report negative earnings, as we saw from Macy's, Kohl's, and Nordstrom last week, those also come in bunches, and that's why keeping up with earnings surprises and how the analysts respond to them is absolutely critical if you're managing individual stock portfolios, because earnings estimate revisions have been documented as the single biggest short-term mover of stock prices. So this model is eclectic, finds a lot of different ways to like or not like a stock. It can like value stocks and growth stocks. And that's a real plus because it's not religious and wedded to just one approach like value or GARP or yield and so forth. So let's look at some validation of the power gauge rating. Life to date through the end of 2015, this includes back-tested results, which are always good, but it also includes 5.5 years of real-time results. Average very bullish stock in the Russell 3000, which is our core universe. We have ratings on 5,000 stocks updated nightly. Research reports on 5,000 stocks, 4-page PDF research reports that you can print out and put in a client file, satisfy some FINRA requirements. Also updated nightly. The average bullish stock up almost 20%. Average very bearish stock, 428 of them at any one given point in time, down almost 1% even after a 6.5-year bull market. When you look at 2015, the results get really dramatic, and we're going to see some of the reasons in just a few minutes. The average very bearish stock in the Russell 3000 in 2015 down 17%. Now, I think all of you know why. It was the energy patch, the Kinder Morgans, the Range Resources of the world. It was also some of the solar stocks, railroads, cloud computing stocks, a whole mix of stocks with bearish ratings that you needed to avoid if you were going to keep clients whole and happy. The average very bullish stock down 1%. So the spread between very bullish and very bearish is significant. And that is one of the proof points that we use to demonstrate the value and the efficacy of the model. 2 additional proof points. We have a partnership with Nasdaq and a partnership with First Trust Portfolios. I know a lot of you buy unit trusts and ETFs from First Trust. We've launched, as you'll see, 2 unit investment trusts starting on December 7th of 2015. With Nasdaq, we created 3 indexes. They back-tested our power gauge rating, stress tested it, and said, we like this. Let's create some indexes. If they outperform their benchmarks, perhaps some ETF creators will license them. And with First Trust, after an 18-month due diligence, they came to us and said, we'd like you to create a portfolio, and I'll show you exactly how that's constructed in a minute. Here's the results, proven results of the Nasdaq Chaikin Power Indexes that were launched April 1st of 2014 with one proviso. These are unmanaged indexes that can only be rebalanced once a year. Pretty daunting task. They said apply the Chaikin methodology and let's see how it goes. Well, it went pretty well. It had been rebalanced 3 times. Nasdaq has a large cap 300, small cap 1500, and most importantly, a dividend achiever index. Now, many of you know the dividend achiever index because Vanguard has an ETF with the symbol VIG that's based on the dividend achiever universe. $26 billion in that ETF. Vanguard has matched the benchmark, minus 2 basis points a year on average for the last 7 years, and they're proud of that, and they should be. That's the promise they made to you and your clients. If you believe in the Dividend Achiever Index, which are stocks that have increased their dividend every year for 20 years, then buy this ETF. Well, we took the best of the best. Of the roughly 234 stocks in the Dividend Achiever Index, about 65 of them made it into the Nasdaq Chaikin Power Dividend Achiever Index. And in 25 months, the Nasdaq Chaikin Index has outperformed its benchmark by 1,000 basis points. That's over 400 basis points a year, and it's been consistent. Imagine what 400 basis points on $26 billion means. It's an awful lot of money, and that's the kind of outperformance you can get with Chaikin Power Gauge and Chaikin Analytics. So I'd like to show you, because I really want this to be a learning experience, the top-down portfolio construction methodology, purely rules-based, that we used to help First Trust create the stocks in the Chaikin Low Beta Growth Portfolio Unit Investment Trust. First launched on December 7th. Series 1, Series 2 launched on March 4th. Series 3 launches on June 1. They came to us and said, after 6.5 years of a bull market, our advisor clients are looking for large cap investment vehicles with lower volatility than the market that still have the ability to outperform. So we did a top-down rules-based methodology. You can actually replicate some of that in Chaikin Analytics using our screener. We started out with the S&P 500. That's our large cap universe, and we screened out the 250 most volatile stocks based on 3-year rolling beta. So we're left with 250 stocks. To satisfy the growth component, we look for companies that are characterized as high earnings retention stocks. Now, what does that mean? A company that we characterize as high earnings retention is one where management sees enough runway 12 to 24 months out to feel confident reinvesting free cash flow back in the business instead of raising the dividend and buying back stock. That's what Warren Buffett would like you to do. That's what IBM's doing for him, shrinking the market cap by using free cash flow not to grow their business because they really don't see growth in their core business, but to buy back stock and raise the dividend. Everybody who rejoiced that Warren Buffett bought Apple or announced a big Apple position yesterday should think twice, because if Apple plays out the way IBM did, which was a 5-year downward spiral for Warren Buffett, who absolutely loves it, he's going to keep buying IBM and he'll keep buying Apple if it drops. Why? Because Apple is raising the dividend and buying back stock. But as opposed to IBM, unfortunately, Apple is borrowing because they've got a lot of earnings, as you know, overseas that they can't repatriate without a big tax bill. So this methodology looks for companies that see growth in their own business and are buying back and are plowing it back into the business. In a sense, it's like insider buying, which is one of the 20 factors in the model. Because management has 3 options. They can reinvest in their own business if they see growth. They can pay out bigger dividends. They can buy back stock and reduce debt. So once we've applied that factor screen, there are now 57 stocks approximately left for consideration to get into this 20-stock portfolio. First Trust said, let's have some sector diversity. We don't mind a little bit of concentration, so no more than 30% of the portfolio in any one sector. And then we applied the Chaikin Power Gauge rating, that 20-factor model. It predicts the market 6 to 12 months out for individual stocks, requiring that the Power Gauge rating be bullish. So the top 20 stocks subject to the sector constraint made it into the portfolio, 20 stocks equally weighted. That's the Chaikin Low Beta Growth Portfolio Unit Investment Trust. With no brand recognition or name recognition, First Trust has raised over $32 million in the two series because this methodology is resonating with advisors. Now, equal weighting, I think, is very important. So does First Trust, because if you've gone through this very disciplined approach, and then you say, well, this stock should be 8%, and I think that stock should be 4%, what have you done? You've completely destroyed the objective methodology. So we've seen two examples: bottom-up stock picking using Chaikin, top-down rules-based portfolio construction. Here's an example of one of the stocks that was in Series 1 and Series 2. It also illustrates what happens when you get positive earnings surprises. We have a new earnings module in Chaikin that analyzes the earnings. Now, this red-green color coding tells you whether they meet or disappointed. So this is Tyson Foods. Power gauge has been pretty accurate. It's been bullish going back into 2015. And the stock has gone from under 40 to about 60. And there have been a series of positive earnings surprises. That earnings report in November is colored red because they missed by a penny, but they guided much higher. And then again in January, after it got put into the Series 1 Unit Investment Trust, positive earnings surprise, and it spiked up to new highs. And then again Monday, a week ago, before the opening, positive earnings surprise. You can see that on the top. They reported on May 9th. They beat estimates. Green exclamation point. A lot of information all pulled together. You don't have to go to 5 different resources or websites to get the information you need to make judgments on individual stocks. Now, here's a stock that can never make it into that disciplined rules-based unit investment trust, Kinder Morgan. How many of you had clients who were hounding you to buy Kinder Morgan at $40 because of the 20% yield? Now, Lord knows after 50 years of Wall Street, anything that yields 20% is a huge red flag to me. But you didn't have to know very much more than that the power gauge was bearish. Now, why was it bearish? Because the financial metrics were very bearish. Too much leverage. No free cash flow when you consider debt service and reinvesting in the business. So Kinder Morgan was bearish. The stock dropped from 40 all the way down to 10 or 11. And it's remained bearish even though Warren Buffett is also buying this stock. In fact, when it spiked up there in April, that's when Warren Buffett and a couple of hedge funds announced that they were buying Kinder Morgan. But the institutions weren't fooled. You can see here's a stock where the relative strength to the market is weak, so the market is agreeing with the power gauge model, and on the upside and the downside, that creates price acceleration, and the institutions continue to be sellers of this stock. Now, think for a moment about what challenges you have in your practice in building your book and your business. Is it too much information to process, too many accounts to really follow effectively, not enough time for new business? These are some of the challenges that we hear about when we talk to advisors at conferences like an Advisor Forum. Now imagine if you could improve your daily performance, save time, and grow your client base, and stay up to date with multiple client portfolios easily, and generate account-specific reasons to call your best customers, which always results in a higher level of engagement and confidence that you're on top of things. What if I told you this is all possible and possible right now? Because it is. That's what Chaikin Analytics is all about. Powerful tools built around the Chaikin Power Gauge rating, a proven 20-factor model to give you smarter portfolio management, enable you to analyze client lists, generate alerts, spot industry group shifts, easily zero in on option strategies if you use options to bring in more income or to protect client portfolios, screen stocks, and create in-depth portfolio health checks. A whole series of functionalities for the advisor to make you more efficient and effective every day. Now, if you happen to clear through TD Ameritrade, we are integrated into the VO platform, and you can see each of your clients' portfolios as a separate list within Chaikin, and then we aggregate them and give you the ability to search and find out, for instance, who owns AbbVie. AbbVie is a stock I made bullish stock of the week this Sunday in Chaikin Market Insights, and I said buy it on a dip to the 60-61 area, and lo and behold, there was some sort of patent expiration. It came out near the close today, and the stock sold off 4%, traded right down to 60. If you're using Chaikin, you'd see the chart, see that it had a bullish rating, positive money flow, outperforming the market. You'll have the courage to wade in and buy the stock instead of sitting there wondering whether there's additional risk, and there may be, but this is a news-driven sell-off. So here's a testimonial from Peter Starr, who is an advisor, but he's listened to my wife Sandy's webinars. Now, Sandy has mastered a very simple way to use Chaikin Analytics, very similar to that bottoms-up pyramid. And she gives webinars that are geared toward individual investors, but Peter Starr has been on those webinars, and he's impressed that it can be as simple as that you don't have to overcomplicate things. So he's decided to get rid of several other services that he's been using for years because he gets everything he needs within Chaikin. Peter, thank you for that testimonial. So for the stock pickers, before we get to ETFs, two patterns, classic Chaikin bulls and classic Chaikin bears. Classic Chaikin bull is Universal Health Services, UHS. Power gauge is bullish. It's now outperforming the market. Chaikin Money Flow is green, indicating that since February, the institutions have been accumulating and it's broken its downtrend. And you had a big positive earnings surprise and the stock spiked up about 2 weeks ago. This is another stock that the computer methodology put into the low beta unit investment trust portfolio. This is one of the 20 stocks, along with United Health, as we'll see in a couple of other healthcare names. Now, classic Chaikin bear, we've already seen Kinder Morgan. It doesn't get any more classic than that, but I'd like to point out a pattern Chaikin that we've been teaching to institutional investors for over 30 years. Chaikin Money Flow, as we said when we were looking at the spider, normally fluctuates between red and green and back again. It's the ebb and flow of buyers and sellers looking back over a 21-day window. It measures the institutional buying and selling. When a stock rallies and gets overbought, and this rally in Kinder Morgan was about 10%, and Chaikin Money Flow stays red or negative, there's a huge opportunity, to quote our Republican nominee, for you to take advantage of that by either buying put options, selling a stale long position, hedging if a client wants to stay with the stock or you want to stay with it, because that pattern has reliably repeated over and over and over again. We see it over here in November, right before a waterfall decline. We see it again when it spiked up on the Warren Buffett announcement. Stock spiked up just under 20 and then it sold off to about 16 3/4. Money flow did not go positive. It's a pimple of green there. There's no buying on that rally. Now, how do you find bullish and bearish stocks within Chaikin Analytics? You find them in two ways. We have Chaikin hot lists that have stocks that have turned bullish this week or have persistent bullish ratings, and we make it very easy for you. There's an example of the stocks that were in that a couple of weeks ago. Micron, which is in the process of bottoming. United Health, we've talked about. Tyson's Food. Entergy, which has been a fabulous stock. SodaStream at the bottom, I didn't even realize that. Positive earnings surprise. This chart was taken about, I'm going to say a month ago for a previous webinar, and SodaStream was on there. Guess what? Positive earnings surprise. The stock was up 25% the day after earnings were reported last week. Second way you can use Chaikin Analytics to find ideas, and this is much more like that top-down rules-based methodology is our new stock screener. In this screen, I look for stocks in strong industry groups with a bullish power gauge rating that had positive money flow and relative strength to the market in the large and mid-cap arena. We started out with 202 names, and we whittled them down to 23. And that's very similar to the top-down methodology that we use to create the low beta growth portfolio. You can create your own client portfolios that can outperform the market because these stocks tend to outperform the market. So there we see Entergy. We see D.H. Horton, which got a big upgrade by a brokerage firm today. Scana, which has done very well. Steel Dynamics in the steel group, very strong. So you can find the winning stocks to flesh out client portfolios. Even if you're using ETFs, you can add alpha to your client portfolios by finding the best stocks through this disciplined screening methodology. Now, one final pattern before we get to ETFs. You've seen how powerful the combination of Chaikin relative strength and the power gauge is, both on the upside and the downside. We've given that pattern a name. We call it the dynamic duo. The reason we like this is because the dynamic duo helps identify big winners and big losers. And superior returns have always come from stocks that outperform the market, even for value buyers. But one caveat, relative strength stands alone as a bullish or bearish indicator. Now, what do we mean by that? My first research in life was relative strength, 1966. Tom Dorsey at Dorsey Wright has built a career on relative strength. I believe if you combine our fundamental model with relative strength, you get the best of all worlds. It's what I call reality-based investing, because the market is confirming what your model is saying, or your fundamental research. So here's an example of a stock where between October and March, First Solar had the dynamic duo working in its favor. The power gauge was bullish, and the stock was outperforming the market, and Chaikin Money Flow was strong. This is the blue chip in the solar industry. And it had gone from underperforming to outperforming. And then, as often happens on Wall Street, out of the blue, the company did something which I consider to be unusual. They had an analyst day where they invited the Wall Street analysts to visit the company. And when they were asked about the guidance for 2017, they declined to give guidance. Why in the world would you invite 30 analysts out to your headquarters and not be prepared to give them guidance? Well, Wall Street hates uncertainty, and the stock broke down. So nothing is perfect in life, and they've been selling the stock ever since. In my view, if you want the blue chip in the solar group, it's First Solar. And by the way, Goldman Sachs recommended it back here at 65 with a price target of 100. That's why it spiked up to 70. They reported a positive earnings surprise, but they guided a little lower. So Wall Street changes, and that's why you need a tool like Chaikin Analytics to help you process all of this information. It really is the age of information overload. Now, let's get to the topic of today's webinar, using sectors and ETFs to create market-beating portfolios. We're going to start by looking at the Select Spider ETFs, which we rank by their power bar ratings. We're going to drill down on a strong sector, use the power bar ranks to find an ETF in a sector with strong potential, and then as added alpha, going to help you find the strongest stocks in that strong ETF. So one thing I do every week, I do it every day, and my colleague John Schlitz, who writes our daily Morning Insights, does it as well, is to look at the 9 Select Spider sector ETFs. As many of you know, these are the S&P 500 carved up into 9 sectors. And we rank them based on the number of stocks with bullish versus bearish potential. Right now, 6 of the 9 sectors have more bullish than bearish stocks, and they have a better ratio than the S&P. It's part of the reason I don't think we're going to get a bear market. But just ranking these 9 sectors or the 20 spider subsector industry groups will give you a sense of where the best potential is in the market. Now, energy has been at the bottom of the list for almost 2 years. Technology has bounced back and forth. Consumer discretionary is right at the bottom of the list. Why? Because there are so many retail stocks in consumer discretionary, and most of them have bearish ratings like Macy's, Kohl's, Nordstrom, and Gap. Now, let's look at healthcare. Now, why am I looking at the 5th rated sector based on the power bar? Well, how many of you have heard too much about sell in May and go away? If you have, just throw your hands up and type a big ARG into the question box. Well, it turns out sell in May and go away actually does work, but not in a way that helps you in the spring. It works because almost every market bottom in the last 40 years has happened in September or October. So obviously, in those years, like 1987 and 1973-4 and 1969-70, when the market's taking a beating and making a double bottom in September, October, the performance from May to November is going to look bad. But there's a little hidden secret that Sam Stovall from Standard & Poor's has referenced in a book that he's written called The 7 Secrets of Wall Street. I recommend that to anybody. It's a little book, but packs a big wallop. 2 sectors actually have gone up over the last 40 or 50 years between May and November: healthcare and consumer staples. So healthcare, with 17 bullish large cap names and only 16 bearish, is a place I want to look if I want to put money to work here in May. Now, you could buy the XLV, which you see on the chart, which is the Select Spider Sector ETF, but those are all large healthcare names, and I look at the relative strength and I see it's red, not green, which means that the XLV has been underperforming the market. So let's see how Chaikin enables you to dive deeper. Using our list manager, you see that in addition to the Select Spider sector and subsectors, we categorize ETFs by industry group, by style, by market cap, and we've got a tab called Health. You click on Health, and you'll see many more names than are fit on the screen. Over 20 ETFs to choose from. How in the world do you decide which to choose? Well, we rank them by power bar rating. Now, at the end of June, we're going to have Chaikin Power Gauge ratings for all equity ETFs, using a combination of the power gauge ratings to reflect the fundamental potential and relative strength and absolute price momentum to reflect the real-world performance of the ETF. It'll be unique, the first time that someone is able to give you a proven ETF model based on fundamentals and technicals. So looking at the healthcare ETFs, at the top is the XHS. It's also a spider healthcare, but it incorporates both small and mid-cap names as well as large cap. Right under it is our partner's First Trust healthcare ETF, 22 bullish and 6 bearish. But let's focus on the best, the top ranked, and drill down and look at a chart of the XHS. And you'll see what attracted me to it. First of all the constituents are ranked by power gauge rating on the left. And if we look at the relative strength, we see that the XHS, which incorporates some small and mid-cap stocks, has been outperforming the S&P. Another thing to note is that 4 of the stocks, sorry about that, in the XHS, HCA, UHS, McKesson, and United Health are in our 20 stock Unit Investment Trust Series 2. So the computer discipline found them, and now this ETF discipline is finding them as well. You can take the best of the stocks in the best ranked ETF and construct your own healthcare portfolio. If you don't want to use an ETF, or if you want to enhance the alpha of this ETF, you could very quickly look through the charts and the fundamentals and decide, well, gee, HCA and UHS and McKesson look pretty good to me. I'm going to put them into my client's portfolio in addition to the XHS, because they're the ones in that ETF that are likely to outperform the ETF. So we've built a new sector view within Chaikin, so you can look at sector ETFs, excuse me, and chart the performance, various time frameworks, and also get a lot of other information. The same kind of information that you would have to go to ETF.com, Morningstar, or FactSet to get. I'm a firm believer that to make your job easier, we've got to consolidate as much information as possible in Chaikin Analytics without overloading you with too much information. So what are we looking at here? We're looking at the 9 Select Spider sector ETFs and the S&P 500. And we can sort them based on 6 different time periods. In this case, we're looking at what they did last week, and we see that energy and materials and utilities were up, excuse me, and consumer discretionary and financials and industrials were down. Well, no surprise about consumer discretionary after those terrible reports from Gap, Kohl's, Macy's, and Nordstrom. Then at the bottom, we give you a breakdown of the top holdings. So ExxonMobil, largest holding in the energy sector. And then over here on the right, some of those statistics that you want to know before you buy an ETF for your clients. In this case, we're telling you that over the past 6 months, energy has underperformed the S&P. Power bar ratio is strong at that point, with more bullish than bearish. This chart was done about a month ago. Tell you the assets in that ETF, the average trading volume, the beta, and so forth. So expense ratio, yield, all the information you should have at your fingertips to make decisions. Now, just last month, we rolled out our new ETF performance view. Those were the sectors we just looked at. Now you can look at all ETFs within Chaikin in a very, very helpful manner. There's a screener in there, and what I did was I clicked on the ETF button, and we've categorized ETFs in the ways that you look at the world. Think of a Morningstar style box. So in this case, I screen for all large cap ETFs by all ETF issuers. And I rank them with one click by their performance year to date. So if you're looking for a large cap growth ETF, the iShares Russell Top 200 Value ETF is right at the top. Even though they call it value, it's really a growth ETF. Right under that are 2 favorites from First Trust. They're large cap growth and they're multi-cap growth. If you wanted to just look at First Trust ETFs, you just click First Trust. If you wanted to look at all iShares ETFs, you could look at all iShares. So we really enable you to zero in on a fund group, a style, market cap. We've sliced and diced this every which way. If you want to look at funds that are ETFs that are actively managed, you can do that. So a lot of information, beautifully displayed thanks to our user interface designers, our graphics people, our product people who really understand your problem because they've been there. Our head of product has started 4 financial technology companies, understands information. Our display people really get it. I'm the cheerleader, but believe me, these guys are good. So we've gotten a number of testimonials. This one from an advisor at Raymond James who came up to me at the conference in California and said, I'm writing to tell you how absolutely incredible Chaikin Analytics has become. Thank you for making my life easier. It started great, but with option screener and sector ETF additions, I feel it's absolutely the best product on the market. I've recommended your product to other advisors in my office. Now, I'd like to end the webinar with one of my favorite subjects, which is playing good defense. I'm sure a lot of you have been on webinars like this, and it's always about finding the best ETF, finding the best stock. It's never about, or rarely about, risk and avoiding loss and how you can do that effectively. So let's look at how you play good defense. Herb Greenberg, who wrote for TheStreet.com and CNBC, penned an article in January of 2014 saying it's the stocks you don't own that matter. This builds on something that Charlie Ellis from Greenwich Associates said in the late 70s when he called Wall Street a loser's game. He wrote a book. And what did he mean by that? He meant in Wall Street, the people who win over the long term are the people who make the fewest mistakes. So 30 years, 40 years later, Herb Greenberg is saying the same thing. Reduce risk by avoiding mistakes. Avoid weak industry groups because they give you a headwind instead of a tailwind. Avoid weak sectors. Know what stocks not to buy. Improve your performance by eliminating potential landmines from client portfolios. So here's an example, Chipotle Mexican Grill, of a stock you didn't want to own in 2015 and 2016. The power gauge has not liked this stock because it's expensive compared to other fast food companies. And then they ran into a buzzsaw with E. coli bacteria outbreaks. Remember the relative strength slide? Batman and Robin, the dynamic duo? I said relative strength stands alone as a bullish or bearish indicator. There are a lot of momentum traders and investors on Wall Street. And what happened here in the summer and fall of 2015 is that they took over or hijacked Chipotle and drove it to new highs, and we made a double top. But then they reported a negative earnings surprise. So before E. coli, they were having problems with their suppliers. They went natural and local, and they couldn't get enough pork for their quesadillas. Core problem for a Mexican food chain. Power gauge turned bearish as the analysts soured on the stock, and then it started underperforming the market. Chipotle was above 630. It was between 630 and 650, and you could have gotten out of it for your clients, doing your job as effectively or more effectively than anybody could possibly imagine. And all the way down, the power gauge and the relative strength have stayed bearish as the company has reported negative earnings surprises based on traffic losses because of E. coli. And along the way in March, just before earnings were due out, we got a sell signal. I made this my bearish stock of the week, but because this was a $560 stock back then, I decided that a put spread would be more appealing. And so I went to our integrated Options Play app. We've licensed this from a company called Options Play because they built the best darn options idea generator based on probabilities, just like the power gauge rating. So why reinvent the wheel when we could roll it out quickly? So with Chipotle at 466 back in March, I called up Options Play. And by the way, for those of you from Raymond James who are on the call, Raymond James is in the process of integrating this into their platform, and Merrill Lynch is also looking at it. So it's getting wide acceptance. So you had two choices. You could short 100 shares of Chipotle, but that would have taken $46,000, or using the vertical put spread, which their program ranked as the best probable trade for risk versus reward, you could have bought a May 470, 400 vertical put spread. Now, for those of you who are using options, you understand that vertical put and call spreads have a better risk-reward ratio than just buying an outright put or a call. And we see that here because the put strategy is circled in green with a 139 rating, whereas the outright purchase of the put, in this case a May put, only had an 87 rating. Now, you could have bought that spread for $2,180, meaning you were controlling 100 shares of Chipotle, $46,000 worth of stock, for less than 5%. And when Chipotle dropped down to 420 just 8 days ago, that spread had widened out from $2,100 to $5,300. So a huge percentage gain. You could have protected clients' positions, put on speculative positions if you're using options for that purpose, all integrated into Chaikin Analytics. Now, I'm running into my own tech glitch, so let's see if we can go on. Yeah, Netflix, another stock where Chaikin has had a bearish rating. I personally think that Netflix has a flawed business model. They actually lost $750 million of free cash flow last year. For the first time in 5 years, they had net negative cash flow. Wall Street is soured on it. Costs a lot of money to produce House of Cards, which most of us love, and buy market share in Europe when your year-over-year subscriber growth here in the US is declining. But the power gauge is objective. It saw that as the stock was making its peak and dropping, and right before earnings were reported, we got an overbought sell signal, meaning the stock made a new 8-day high with a bearish power gauge rating. And we put out a sell recommendation on Netflix, and it dropped from 110 to 90, and it really has not looked up ever since. This is a stock that has problems, and any rallies, in my view, are an opportunity to get out of it or protect clients' positions. But this has happened before. Back in 2014, before the stock split 7-for-1 and ran all the way up. By the way, the power gauge actually turned bullish after this. We had a bearish power gauge, an earnings report due out, the same overbought sell signal. And I was on CNBC and said, buy puts on Netflix ahead of earnings. People who bought out of the money puts made 50 times on their money overnight. One subscriber to Chaikin bought 3 contracts for $22 and 3 days later had a $21,000 profit. Gave us this testimonial. This goes back to October of 2014. So patterns repeat. Turns out the October earnings report for Netflix has been poor almost every year for the last 5 years. Now, it's not just big cap, well-known names, although SunEdison sadly was way too well known. We looked at First Solar, which actually made a new high before they goofed on their analyst day, but the power gauge rating on First Solar turned bearish in mid-July with the stock at around 28. Merrill Lynch had a buy rating on it. Along the way, the institutions couldn't get out of the stock fast enough. It turned bearish in terms of money flow and relative performance. And in that circled area, I basically said this company is going bankrupt. Now, I did a little digging and found out what they were doing in their balance sheet, moving receivables off the balance sheet, and playing Enron type games. But an advisor from Merrill Lynch came up to us at the conference in California last week and said, Merrill had a buy rating all the way down. I actually bought more of the stock for my clients at 15. And then, of course, they filed for bankruptcy. Merrill put out a sell recommendation of $3. You can do better than your firm's research, or you can use Chaikin as a filter to get a reality check, because guess what? Merrill Lynch still has a buy rating on Solar City, another Elon Musk disaster. Even though the company reported a negative earnings surprise, guided lower, and dropped 25% last week, Merrill still has a buy rating on it. Chaikin Power Gauge has been bearish for over a year on Solar City. Now, this is a recent bankruptcy that was preceded by a bearish Chaikin Power Gauge. If you go back to 2014, GTAT, which had been a solar company, was making sapphire glass for the iPhone 6. So this is July through October of 2014, just before iPhone 6 was announced. Power gauge turned bearish. The institutions were selling it. When the iPhone 6 came out in September, there was no sapphire glass. And ultimately, the company filed for bankruptcy. So another example where a bearish Chaikin Power Gauge rating could have gotten you out of trouble. By the way, guess who's buying their plant in bankruptcy because they lent them the money to build it? Apple. Almost like dealing with the mafia. They lend you the money to build a plant, then they decide not to use your glass, you file for bankruptcy, and they pick up the assets on the cheap. Third and final example. Jim Cramer. I think he's actually smarter than people give him credit for, but even the gurus get it wrong. You can take control. You don't have to be dependent on what you read in Barron's or what your firm's research department is saying. You could have an independent check. So in mid-April, Jim Cramer said Energy 21, EXXI, made sense. I mean it. Yes, I know it filed for bankruptcy yesterday. So one can conclude that the company was reckless, but Jim Cramer got seduced by the management, which he did in La Quinta as well. I know he uses the Chaikin Money Flow because he talks about it a couple of times a month. If he were using the Chaikin Power Gauge rating, do you think he would have stayed bullish on EXXI all the way down for a year with the stock underperforming the market? Folks, it's not that difficult. My wife Sandy has proven you can keep it simple and stay out of trouble. So Chaikin Analytics for iPad and desktop. The desktop version now includes the stock screener, options play, earnings alerts, and all that ETF and sector functionality. Here's a feedback we got from an advisor on the West Coast who showed a client her portfolio in our portfolio health check application. She was so impressed that he was using an independent third-party research product on the iPad, which he brought to the client meeting to monitor her portfolio, that she gave him an additional $500,000 to invest. And that money came from a TD Ameritrade account that he had no idea she had. This was a Raymond James advisor. You all have clients that have accounts and you don't know about them. And Chaikin Analytics is one way that you can generate that kind of confidence that gets more of your clients' assets under your control. So Chaikin Analytics for iPad and desktop is normally $1,950 a year. We've got a webinar special. We're reducing the price by $200 to $1,750. Go to chaikinanalytics.com/exceed. This webinar has all been about outperforming benchmarks, not accepting average performance. This offer expires Friday, May 20th. chaikinanalytics.com/exceed. Now, what do you get with Chaikin Analytics? You get, we're experiencing the gremlins here as well. Chaikin Market Insights weekly newsletter, our daily morning insights from John Schlitz, so you don't have to stay glued to CNBC before the market opens and you'll know exactly what's going on overseas and in the futures markets. Small group tutorials to help you get set up using Chaikin Analytics as quickly as possible. And our new sector and ETF analytics plus the stock screener and the earnings alerts, and by the end of June, ETF rankings. Now, one final testimonial from Joel Bruckenstein, who edits Financial Planning's annual tech survey. Chaikin Analytics is clearly valuable for advisors who take an active approach to asset allocation. It really does pack a lot of data and analytical power into a very small package. And I know Joel is looking at us again because that review was written before we added all this new functionality like options play and screener and ETF and sector screening capabilities. So Joel is probably the foremost analyst of technical resources, technology resources for advisors, and gave us a big shout out. Now, I really believe in this product. I came out of retirement to build it. I assembled a team of 24 people here in Philadelphia. We've got great support and education for the product, constantly enhancing it every month. We make new functionality additions. So I'd like to give you an incentive to take advantage of Chaikin Analytics now before these ETF ratings come out so that by the time they do, you're fully conversant with everything that it can do for you. If you subscribe by midnight tonight, we'll take an additional $100 off, reducing the price to $1,650. And as an added bonus for the first 10 people who subscribe by midnight tonight, you'll get a one-on-one telephone call with me. They typically last a half hour to 45 minutes. And as part of that phone call, I'll walk you through that disciplined rules-based methodology which we use to help First Trust create these low beta growth unit investment trusts, which by the way have been outperforming their benchmark, which is the S&P, from day one, both Series 1 and Series 2. So I'll walk you through that process, hear what your particular investment style is, and show you how to use our screener to come up with a list of stocks that meet your criteria on both the long and the short side, because I know from meeting you at conferences that many advisors go short in their own accounts for clients, for aggressive clients, or buy put options. And I'll show you in that one-on-one phone call how to use our screener to create lists that are custom tailored to your style and your approach to the business. So I'd like to thank you for staying with us through the technical glitches. Hopefully we'll have them solved by the next webinar. We do these once or twice a week, not always geared to advisors, but often they are. So thank you very much. Have a great evening, and I'll turn this back to Joe Bicella to wind down the webinar.
Excellent. Well, thank you so much, Mark. Thank you for your presentation here. We want to thank everybody for coming out this afternoon. And again, to echo Mark's sentiment, thank you very much for your patience. We were happy to get our technical issues resolved. But absolutely, I'm sure we hope you enjoyed the session tonight. Keep an eye out for a recording. We did record tonight's session, so look for that in your inbox tomorrow morning. We'll have that sent out to you. If you do have any questions, our contact information is available at the bottom of the page here. You can send us an email at sales@chaikinanalytics.com, or you can give us a call at 877-697-6783, or simply go to chaikinanalytics.com/exceed. You'll see the link right in your chat window. So again, we want to thank you very much for coming out today. Thank you to Marc Chaikin for his time. Thank you for attending our session, and we'll see you tomorrow.